The news is everywhere. Gold has officially hit $4,000 an ounce for the first time ever, shattering previous records and signaling that the landscape of global finance is fundamentally changing. This is an explosive price point that doesn't just benefit speculators, it fundamentally alters the economics of mining and the future of geological exploration worldwide. We need to understand not only why this is happening, but how these massive financial shifts translate directly into opportunities for geologists and the entire earth science community. We are witnessing a historical structural shift in the financial world, largely driven by the quiet but powerful actions of the world's most influential financial entities, the central banks. For the first time in nearly 3 decades, since 1996, the combined gold reserves held by foreign central banks have actually surpassed their holdings of US Treasury securities. This incredible crossover is a profound symbolic moment, confirming a major diversification away from paper, dollar-denominated assets, and firmly toward tangible hard assets. Central banks worldwide have been on an unprecedented gold buying spree, accumulating over 1,000 tons annually for the past 3 years straight. To put that into perspective, in 2022 alone, they purchased a record 1,136 tons, marking the largest single-year accumulation seen since 1967. This sustained institutional appetite acts as a colossal, sticky demand floor that is soaking up about a quarter of global mine output every year. So why are these institutions dumping dollars for dirt? It all comes down to national risk management in a world of rising geopolitical tensions and economic uncertainty. Central banks view gold as the ultimate neutral safe haven, because it carries no credit risk and, critically, offers resilience against international sanctions. Unlike foreign currency reserves, which can be frozen overnight due to a political disagreement, gold is a physical asset that provides sanctuary from global political volatility. This calculated strategic pivot means reserve managers are prioritizing durability, portability, and neutrality, the core qualities of gold, over the traditional yield offered by US Treasuries. Emerging market economies are leading this charge, with major accumulators including China, Russia, Poland, and Turkey all dramatically increasing their gold holdings. In fact, central banks now collectively own approximately 17% to 20% of all the gold ever mined in human history, demonstrating their deep commitment to the yellow metal as a strategic reserve asset. This robust, long-term structural demand floor underwritten by sovereign nations is the most important signal for the entire geological community. When prices are persistently high, the economic viability of new and challenging mineral deposits fundamentally improves, incentivizing the high-risk, high-reward investment necessary for exploration and development. This elevated price environment means that the search for the next generation of gold resources just got infinitely more lucrative. Speaking of gold resources, let's zoom in on the geological reality. Scarcity. Gold is truly rare, and it's getting harder and more expensive to find the next commercially viable deposit. If every ounce of gold ever extracted, all 216,000 tons, were melted down, it would form a single cube about 22 meters tall, roughly the height of a 4-story building. The amount of easily accessible gold is rapidly diminishing, which highlights why this high price is so crucial for exploration. The world's proven economically recoverable gold reserves total only about 64,000 tons. That remaining stock is shrinking every year, forming a much smaller cube just 15 meters tall. Nearly 3/4 of all known gold has already been pulled from the ground, with the vast majority extracted since 1950, thanks to modern, large-scale mining technologies. However, new discoveries are now much rarer, and increasing extraction costs, coupled with declining ore grades, continually threaten the supply chain. This structural scarcity, combined with insatiable central bank demand, places immense importance on finding those remaining recoverable reserves. For geologists and ore prospectors, sustained prices above $4,000 an ounce mean that previously marginal or deeply buried deposits are now worth targeting. It supports aggressive drilling and innovative recovery technology to access reserves that major mining companies need to replenish their declining inventories. Now that we understand the economic drivers and the geological supply constraints, let's tackle the mechanics of how that 4,000 price is determined moment to moment. The gold price isn't set by a single oracle or a shadowy cabal. It's a dual system composed of a fixed institutional benchmark and a continuous market rate. First, there is the dynamic continuous spot price, which is the price for immediate payment and delivery that you see constantly fluctuating on financial tickers. This real-time valuation is largely dictated by high-volume trading in gold futures derivative contracts, primarily conducted on the US COMEX exchange. A gold futures contract is essentially an agreement to buy or sell a set quantity of gold at a specific price on a future date. Because the largest volume of trading occurs in these paper contracts, the consensus of advanced investors and speculators heavily influences the immediate spot price. The futures market is the fastest mechanism to incorporate geopolitical shifts, inflation expectations, and market sentiment, which is why the spot price is so volatile. Second, we have the formal institutional reference price, the LBMA gold price, formerly known as the London Gold Fix. This fixed benchmark is set twice every business day in London time, once at 10:30 a.m. and again at 3:00 p.m. through a transparent electronic auction process administered by the ICE Benchmark Administration, IBA. This process involves about 15 major international banks and trading firms who enter their buy and sell orders by volume into a multi-round auction. The price iterates, moving up or down until the net volume of buying and selling interest falls within a strict clearance threshold, currently set at 10,000 troy ounces. This fixed price is the critical valuation point used by central banks, refiners, and institutional investors globally to settle large-scale contracts. The acceptance of these dual prices is based on a foundational framework of integrity maintained by the London Bullion Market Association, LBMA. The LBMA owns the intellectual property rights to the LBMA gold price and enforces the stringent good delivery list standards for physical gold bars. This system ensures that all gold traded meets rigorous standards of purity and ethical sourcing, which is vital for maintaining confidence among central banks and major global counterparties. However, no matter how rigorously the price is determined, the price itself is always reacting to the underlying forces of the global economy, especially the financial tectonics of the US monetary system. The single most important factor driving gold prices is widely considered to be the movement of US real yields. Since gold is a non-yielding asset, meaning it pays no interest, its appeal is constantly weighed against the inflation-adjusted return offered by safe alternatives like US Treasury inflation-protected securities, TIPS. This results in a potent inverse relationship. When real yields rise, gold becomes less attractive and prices tend to fall. Conversely, when interest rates lag behind inflation, creating low or negative real yields, the opportunity cost of holding gold is reduced, which drives demand and prices upward. The gold price is also tied to the performance of the US dollar, USD. as the metal is universally priced in this currency. When the dollar weakens against other major currencies, gold becomes cheaper for international buyers, which boosts global demand and pushes the dollar-denominated price higher. This is the curious dance where the decisions made by the US Federal Reserve about interest rates can send shivers through the global gold market. The ultimate price accelerant, however, remains safe haven demand. Gold maintains its historical role as the crisis commodity, a store of value that investors flock to when confidence in financial markets, fiat currencies, or political stability is shaken. Whether it is rising inflation fears, geopolitical clashes, or domestic political uncertainty surrounding major elections or debt ceiling crises, fear is a powerful motivator that pushes gold higher. For the geological community, this confluence of factors, scarcity, strategic central bank buying, and political volatility guarantees that the economic fundamentals for gold mining and exploration are healthier than they have been in decades. The push for long-term reserves is now a matter of national strategic importance, underwriting the next wave of major discoveries. The future looks bright and very yellow. If you are interested in these subjects, please subscribe, hit the like button, leave a comment, and share this channel with your friends. Until next time, keep exploring.
Welcome to my channel, where you'll find over 2,000 videos on geology, geochemistry, AI, and many other subjects. If you like what you see, help us grow by subscribing, liking, and sharing this channel.
I think these videos are brilliant, and I'm sure you will like them too. Please like, comment, and subscribe, and don't forget to click the notification bell.